Let's try this again. This is like my third time recording this video because I kind of can't figure out how to explain this properly. So I'm kind of working on my communication skills and trying to explain this to you in a more simple way where you can understand it. So in this video, we're going to be talking about fair value gaps. And now, fair value gaps are an important and also a key part of my strategy, but they are also very simple to learn. This is one of the most important things in my strategy. So, with that being said, let's get into why this is the case, right? So, there are a couple different types of fair value gaps. There's a regular fair value gap and an inverse fair value gap. I mean, there's only two, right? So there's an inverse fair value gap and a regular fair value gap. Now I'm going to be talking about two of them, which is inverse and fair value gaps. The fair value gaps that I use the most are inverse. I don't really use regular fair value gaps like that, but I do use inverse fair value gaps a lot. I don't use I don't just go off by regular fair value gaps. I go off by inverse fair value gaps. So, with that being said, let's get into it. Okay. So, this is how a fair value gap would ideally move, right? So, we're going to talk about an inverse fair value gap. So, let's say we have price retracing back up and we're in a downtrend, right? Let's say that this is the scenario and we have price retracing back up. We would come up here, tag up here, and then come back down lower. Now, that's an inverse fair value gap. Now, let's say the scenario is just a regular fair value gap, right? So, let's take all of this off, right? A regular fair value gap would just be us coming up here and filling this whole entire thing and then continuing the price up to wherever the market's going. Correct? So, with that being said, I'm going to try to explain this to you in a way that you can understand. Now, fair value gaps are just basically exactly how I have it drawn out right here. We connect the wicks of the candles to the next wick, and you'll be able to see that in multiple occasions. And if you don't understand right now, I'm going to show you a live example of it. Not really a live, but one in the replay bar where I could show you on how it would work, or in a scenario where ideally it would be live. So, with that being said, let me show you how this would work, right? So, a regular fair value gap, we're anticipating for this area of this imbalance to be filled. A fair value gap is just an imbalance in the market where orders need to be filled, and it's just an area where ideally big wicks come down, form these fair value gaps, and it needs to retrace back up there to fill it, to either continue where the price is going or to change the direction of the price. So, with that being said, let me show you what it would look like in a bullish scenario. In a bullish scenario, same thing. It's just kind of flip it around as it would be in a bearish scenario, right? You would just come up here, right? Then come back down, tag into here, and then come back up. Fill the fair value gap. Allow the fair value gap to be filled, right? Do we have anything else like a brush, something? Um, yeah, a brush. Okay. Allow the fair value gap to be filled right here, right? Allow this to be filled and then to come back up. So it would just ideally come retrace back down and then swing back up. So same thing for the bearish scenario, right? Let's say we're retracing, touch into this fair value gap, and then come back down. That would make the fair value gap an inverse fair value gap. And then this would also make it an inverse fair value gap, right? So, but with the scenario of the bullish where it's not an inverse fair value gap and it just fills it, right? We just come back down, we just fill it, then that would just be a regular fair value gap. Now, you can use fair value gaps to take entries off trades. I wouldn't just recommend taking an entry just off based off a fair value gap. I would recommend that you use other confluences as well for your trade. But a fair value gap is a good way to take an entry off a trade. Now, with that being said, let me show you how it would look like in a real example. Now, this is a perfect example right here, right? So we formed a fair value gap right here, right? Formed the fair value gap right here. This is an imbalance. You could see how we touch this. This makes it an inverse fair value gap. So chances are, and the trend is changing, so chances are we'll continue going up to the highs, right? You could take a position off here, set your stop a little bit below that fair value gap just in case it fills it, and then swing it up to take out this area right here, this high right here, right? And then allow the trade just to play out, right? Fills it again, goes to fills it again, fills it again. Continue on going to do what it needs to do. Let me speed this up for you. Bang, hits to take profit. And then there you go. So, as you can see, just based off this little thing, this little area right here, just based off this little area right here, we took a trade off and we took an entry off. Just based off this little area right here where we took a trade and an entry off. Now, because we knew but you also want to use fair value gaps one in combination with the trend, right? You don't want to go against the trend, right? So we were in an uptrend right here. We started reversing the trend right here in this area right here. And then I saw an opportunity right here. See, a fair value gap was right there. Let me show you. You can see it a lot better. You just want to place the fair value gap by the wicks like that. And then you see we tap into the fair value gap again to fill everything. And then we go continue on to take out whatever we need to take out. And we come up right here. So, with all that being said, that's an inverse fair value gap. Let me show you what a regular fair value gap looks like. Okay, we have a perfect example right here. Perfect example right here, right? And never mind, no, we don't. I'll be right back. Okay, we can have. We're probably gonna have another scenario right here where it plays out. You could see we fill that fair value gap again, and this is what a regular fair value gap looks like, right? So as you can see, I marked out where we were, right? We had this fair value gap right here. And since we're due for a retracement, we're probably going to fill this fair value gap until we get to this area right here where we have the original consolidation. You could even consider this as an order block. We'll talk about this in another video. But as you can watch it play out, you could see we fill that fair value gap and then we swing back up and then we come back down. Almost touching this fair value gap. But chances are you can take a long position to take out uh this high right here. So allow to do its thing. Fills this fair value gap again. See, so these are two good examples, right? We fill this fair value gap, and then this isn't a fair value gap though. This is an order block. But as you can see, this is a good example. We filled this fair value gap, and it wasn't inverse. We filled it, retraced back up to the upside, and then continue going down. But we also have another fair value gap right here. As you can see, tap into this fair value gap. We tapped into this fair value gap during London session. So London session opens around here. Let's see. Okay, there we go. Now you could take this trade to the upside, right? This was the inverse fair value gap. So now you could take this trade to the upside. And you use your discount, which we'll also talk about in another video. You could take a buy right here and target long to the upside. to right here. Set your set your stop loss a little bit low for a 2 to R ratio, and just watch. As you can see, literally hits my take profit, but if I just set my stop loss a little bit more like that, we would have been fine. And if I had a better entry as well. But overall, it does hit my take profit. Just got stopped out by a little wick. But you could see how we never closed below these fair value gaps, right? Like not this one. We filled this one, but we never closed below this one. The wick of the candle never closes it. We only get the wicks outside. So we never close below these fair value gaps, and the body of the wick is right here. So we always close within the fair value gaps. That makes the fair value gap a little bit more of a high probability fair value gap. Going on so far, you can see we just continue going up on the way up. So that's inverse fair value gaps for you, right? Now I'm trying to find. This is also a good example of what a regular fair value gap looks like, right? Where we just fill it. You could use these as target in places as well. So let me just keep showing you. And then we just continue going back down, come back into the fair value gap again, and then we fill it up again. Look at that. We just tap that fair value gap and then we swing back up. So you can use that as another confluences to take another trade as well. So let me try to continue showing you another example. I just realized there's another perfect example right here, right? Look, we have another perfect example of a regular fair value gap right here in this area, right here. You can see we filled this fair value gap right here. So let's say the scenario is where you're in an uptrend, but you're seeing the price retrace down to the downside, and it makes big wicks like this. You could use the fair value gaps in here to target. So you could have taken a long position off right here as well, right? You missed the move, and you saw that there was a fair value gap above. You could have taken a long position to the upside all the way up there, targeting that fair value gap as well. And then you would have been fine as well, taking out that high as well. That's another example of a regular fair value gap. But I mainly use inverse fair value gaps, as you can see where we bounce off. I never use fair value gaps that fill. So this isn't really my expertise right here, right? I don't really use this as often. This isn't really where my expertise lies. I just use inverse fair value gaps, where price just bounces off it. So like the candlesticks, so you see how the candlesticks bounced off right here, right? You see how we came down and I caught this fair value gap right here, and then it came down and then bounced back up, then came back down and then hit the take profit, then came back down into it, bounced off it again, and then took it out again, and then just continue going back up. That was a weird. This is so weird. That was a weird way for me to draw my arrows. I apologize. But you can see how it bounces back off, right? And it does that. That's how powerful an inverse fair value gap is. You could use a fair value gap for entries. You could use them for entries. You could use them to think about where price is gonna go next and what the probability of it is. Usually you want to use fair value gaps with long wicks, right? So like this is a perfect example right here. You see these long wicks right here? And how I was able to draw them out. These are usually higher probabilities because these make imbalances in the markets. And then you could just take an entry off right here and then continue into the upside. Came back down and targeted these highs and then came back down, tapped it again. You could have targeted these highs now. And you could have used this fair value gap right here, this fair value gap right here, to take another entry as well, right? This is another entry as well, right? You could have entered off this fair value gap right here. And this one is just filling it. It's not even an inverse fair value gap. But you could have taken off an entry off right here for a little scalp as well. But that's really it. I mean, there's not really much to go about with fair value gaps. But fair value gaps are important. you can see how price bounces off right here, taps into the fair value gap, comes back up, and then swings up and then takes it out. And then you could see here as another example as well, right? Price taps into here, comes back up, takes out these highs, and it just continues to trend. And this was a 5-8 risk to reward. So it's not bad. It's not bad. But with all that being said, this is fair value gaps. If you guys need any more explanation into it, then let me know and I'll try to help out. With all that being said, enjoy your night or day or afternoon or morning, wherever you are. Okay. Enjoy your night.